Let's introduce Jonathan. So, good morning, Jonathan.
Good morning. Thank you for having me.
Well, very pleased to listen to the story. So we've got some slides that we can rattle through. So as normal, do you want to sort of start off by explaining a bit about what the fund is and what it's trying to do, please?
Yeah, no problem at all. So Kent, or Triple Point Energy Transition PLC, IPO'd back in October 2020 now, and IPO'd looking to deliver up to 8% NAV return to investors and pay a 5.5p dividend, rising progressively over time. Really what it's focusing on is investing across the whole of the energy transition, not just a kind of single technology or certain part of it, to deliver a broad, diversified range of opportunities to investors. And I think what this slide just hopefully tries to distill on a single slide is just some of the points of difference. We know it's a crowded market space in the energy transition. What are we doing that's a bit different? And yeah, to your point, trying to give you a sense of the nature of the company and I guess some of the key highlights. So taking that first point on the top of the slide, what we do, what the core of Kent is trying to do is to look across the whole of the energy transition sector, to look for the areas of mispriced risk, to look for those areas where we can get a more attractive risk-adjusted return. And we really focus on niche areas of the energy transition, niche technologies, to be able to do that. So if you look on the right-hand side, and we'll come on to it in a bit more detail later, but the technologies you see in our portfolio are combined heat and power, gas engines. You see hydroelectric power, LED lighting. There is solar, but only at development stage. And so I guess the point I would make is what you're not seeing is large scale operational solar, offshore wind or onshore wind. Those are, interesting areas of the energy transition, but ones that we feel have been subject to quite a lot of yield compression, high valuations, as lots of money is poured into those areas. And we think there's more interesting returns in those niches that we've looked at and that we've got in our pipeline, which I'll talk about later. The other thing that's a bit different about us is, as well as investing across the whole of the energy transition, we also invest in both debt and equity structures. Probably that's best explained why we do that through an example. So I think at the moment you might expect a solar project to maybe, if you bought the equity in that project and the project IRR to maybe be 6, maybe 7% on a good day. If you were lending, however, to a sort of a slightly more complex technology, perhaps energy from waste or bioenergy, you might be able to get teens returns just through lending into a debt piece. And so I guess our view was targeting high single-digit returns. We could put together a diverse portfolio of these things, investing in both debt and equity. So we really search out the interesting part of the capital structure and put together a portfolio of assets, which is diverse by technology and diverse by how we lend or invest in it through debt and equity. The second thing that naturally means, if you invest across the whole of the energy transition, is it brings a natural diversification to the holdings that the trust has. So we've got 5 different technologies, as I mentioned. We've got 19 individual assets, so well, broken down by assets, no overexposure to a single asset there, and 9 different offtake counterparties to which we sell heat, we sell equipment, we sell electricity, so a diverse range of products as well. And our portfolio is at the operational stage, development stage, and construction. So again, what you're seeing there across the stage of development or revenue or technology base is a high level of diversification. I guess the third point, which we think is quite unique in the market, is the really high levels of contracted income for the trust. So in FY23, we announced our results on Monday. 100% of our income was underpinned by contract, and 46% of that income was contractually linked to RPI through subsidy payments on our hydro portfolio primarily. But I think the really interesting piece for investors maybe looking ahead is over the next 10 years, in fact, indeed over the next 14 years, 92% of the forecast income is underpinned by contract. And we think that gives a really nice risk-adjusted return, a really stable underpinning for earnings to our shareholders. And those earnings, as we reported on Monday, we think have been really encouraging in the portfolio to date. So our dividend cover on a cash basis was 1.1 times. Actually, if you strip out the effect of an exceptional item from back in November, it was 1.2 times. And our NAV returns are ahead of target. We delivered a 9.2% NAV return. And as we've said on the right-hand side of the page, based on the share price as of the 31st of March, that's an implied yield of 9, which even in this high base rate environment, we think is quite interesting. I think the final point on here is around that we've still got a lot more, I guess, earnings to come on stream. So when we look at our portfolio, you'll see that we've got about £40 million worth of battery energy storage assets to build out. And obviously, as you build those out, you deliver earnings from those, and that you'd expect would further drive the dividend cover figures that I've presented here. So there's, even if we, in a difficult environment in the markets, we've still got ability to drive profits and drive earnings to shareholders from our resources already. And finally, the last point on there is our pipeline. We think this is really important. There's a lot of I guess people thinking about whether this is still an attractive asset class to invest in this world of higher base rates, and obviously 50 basis points increase the other day. We think it absolutely is, but you've got to be able to find those niche areas. And for us, those at the moment are things like electric vehicle charging or charging infrastructure, electrification of the fleet, green hydrogen production, for example. And those returns tend to offer slightly more interesting returns at the high single, even double-digit return level. And so that would suggest that as the trust scales, we will be able to drive the weighted average return up and deliver higher returns to shareholders. I think the danger with being a single technology investment trust is obviously your return will always be linked to a return on that single technology in a single place typically. And so we think that broad focus across the transition enables us to look for those interesting returns as well going forwards. On the next slide, we've tried to do what probably many smarter people than us have tried to do, which is to summarize the entirety of the energy transition onto a single slide. There's therefore some obviously some serious generalizations here, but broadly we think about our addressable market in these three buckets. So starting on the left with generation, clearly the way to get to net zero is a net zero power system, and so renewable generation is clearly a really important part of that. Now, we've invested in hydroelectric power. We think the returns there are slightly more interesting than solar and wind. But this is clearly a huge part of the energy transition, and without it, you're not going to get there. The second part of the energy transition, if you almost follow the electrons as they flow from the point of generation through the transmission and distribution cables and into storage, is battery energy storage is also a really important part of the system now. You've obviously got the fact that I think last year, there was enough energy from wasted from wind curtailment, so switching off wind turbines alone to power over 1 million homes, and over £1 billion of balancing costs was faced by consumers. So that's not great for getting to net zero, wasting all that energy. It's not great for affordability of energy bills, and so battery energy storage we think is super important to getting there. The third component of your net zero power system, of the transition to net zero, is actually what happens on site. So as electrons then flow from generation, they flow through the distribution and transmission, they've maybe been stored and then released at the point of demand. We get to net zero in terms of tackling things on site by doing either reducing the level of demand at a building, for example, or in industry. That could be through installing LED lights, for example, to reduce consumption, or through generating that requirement on site. And that could be combined heat and power or rooftop solar. So, but there's broader opportunities, as I mentioned, in electric vehicle charging, EV fleet, and green hydrogen, as well as heat networks, which are an increasingly important part of the way we need to decarbonize our heat, and of course, pumps. So a really interesting range of technologies, and typically, actually, that's where the most interesting risk-adjusted returns are. There's less competition, frankly, in terms of capital flowing in there, and there's much more interesting business models and innovation in that space. So turning on the next slide, you'll see our portfolio and how it maps to each of those three segments that I've just spoken about. So that starting again with generation, as per the previous slide, we've got our hydro portfolio that I mentioned, and we own the equity in that in a portfolio of 9 run-of-river assets spread across the Highlands of Scotland. We really like hydro, I guess, because, as I mentioned, slightly higher returns than solar and wind. We've got feed-in tariff subsidy here, so north of 90% of the price is kind of contracted and driven by that subsidy until 2035. So again, really high levels of contracted income, and that level of subsidy increases with RPI each year. So I think last year it went up by 13%. So really strong contractual, government-backed offtake for inflation. Quite important at the current time, I would suggest. The other thing we've done in that generation space is invest in development. We're allowed to deploy no more than 5% of the fund in development, which has a slightly higher risk profile. But we thought the really interesting opportunity here was actually lending to developers. I know a lot of other players in the market sort of start developing, for example, a solar farm, and then they hold that for the operational period. We think that development of renewable assets in its own right is a really interesting opportunity. We've got I think over 50 gigawatts, well over 50 gigawatts of assets trying to be built onshore, let alone offshore at the moment. And there needs to be funding for them. And increasingly, there isn't sufficient funding given the long grid lead times and also the fact that planning is taking longer. So we funded one of the most established developers in the UK, a company called Innova Renewables, and that is a loan secured against their pipeline of projects. So we think that's a really interesting avenue of further opportunity for us and a really interesting, important part of the energy transition. In that second segment, energy storage, we've decided to lend to battery energy storage, and I'd be delighted to talk about why we decided to lend rather than do equity. I think there's a really interesting debate to be had there around the long-term revenue case in battery storage in the UK. We felt that that was a more prudent way to invest in this asset class, and we've committed 45.6 million, of which 6.2 is deployed. And I mentioned earlier that the remainder of that we expect to be deployed over the next financial year, providing incremental earnings to the fund. And finally, on the on-site piece, we've invested in 3 CHP ESCOs or energy service companies, and we've got 25.1 million outstanding to them, and also LED lighting with an investment grade off-taker. So again, real diversification by the different structures, receivables financing, senior debt, equity, by technology, by the different segments of the market. And so again, and also a mix, as I mentioned, by debt and equity, as you can see in the pie charts there. On the next slide, we've just tried to give a little bit more granularity to people around exactly what is deployed. There's a bit more still to come, clearly, in the battery storage that I mentioned. And in the post-balance sheet period, we've deployed 9.9 million. So the total, gross asset value of the company is 132.1 when you factor in commitments and deployments. And I think what the right-hand side of this slide is trying to show is the real diversification by segment, by technology, but again, by asset. And you can see that there's no one single asset is particularly large. We've not overly focused on that, and we think that's really important in the energy transition at the moment, particularly with REMA and other consultations on changing pricing coming down the track. On the next slide, we wanted to give a little bit more granularity around our revenues as much as we were able to, and to show you, because we think probably one of the key selling points of this company, we think, is their contracted revenues, and we've got their 92% over the long term. I would suggest that that's really important at the moment, given that we are seeing power price expectations cool off. We are seeing inflation expectations cool off, albeit not as quickly as probably the Bank of England would like. And so in that environment, that level of contracted income, especially when it's dividend covered, of course, is really important, and I think a real differentiator, and we think makes us a lower risk profile than many other investment trusts and some of our peers to have that for such a long period of time. And you've also got that inflation protection I spoke about there as well. Again, that comes through the government subsidy, and again, that goes well over a decade. We've tried to give a bit more detail at the bottom there around how that breaks down by assets. So we're really proud of how we construct and have thought about the revenue streams that underpin our earnings to shareholders, and how we make sure they're really well downside protected, whilst providing that attractive yield, as I mentioned, of 9% based on the 31st of March share price. I think on the next slide, I'm just summarizing some of the key points and highlights of our results that I mentioned we announced on Monday. The two real key ones to highlight, clearly, that NAV return of 9.2%. And I think, again, we think you should see that in the context of the strong downside protections. Again, the fact that we're not just equity, we're equity and debt, and the fact that we've got that high level of contracted cash flow, that risk-adjusted return to shareholders, we think is really strong. And we're really proud of the dividend cover, which is 1.1 times, 1.2 excluding exceptionals, and with more earnings to come as we build up that battery portfolio I spoke about. Our underlying portfolio grew in valuation over the course of the year, and that was driven primarily by expectations in power price increases and inflation. It was offset by increases in our discount rates that we apply to value our assets. Probably the one other point I'd call out on here is that Triple Point, the manager, has a lot of conviction in this investment strategy. We take actually 20% of our fees in shares to align our interests with our shareholders, and in addition to that, Triple Point has bought a little shy of 400,000 shares in the period and bought a few 100,000 more subsequently. So Triple Point's a real believer in the strategy and the opportunity that this is trying to take advantage of. And I think the last two slides, this is about our pipeline. I thought this was really interesting to show, and hopefully listeners and viewers will be interested in this as well, is to try to break down the sorts of returns that we're seeing in the market for different types of opportunity. We've got this really privileged position to sit across the whole of the energy transition, looking at debt and equity. Where are we seeing returns? And of course, we should all be seeing this, in the context of where the risk-free rate is. Again, distributed energy generation is just a classic example of where there were some really interesting years of returns, and then a wall of money sort of arrived and compressed returns, particularly in solar and onshore wind and offshore wind, to reduce the returns to a level that now, when you think about the risk-free rate, isn't that interesting anymore, I would suggest. And you're starting to see that, I think, in energy storage, where returns are starting to compress. Obviously, you've had a backdrop of higher equipment prices, lithium carbonate and so on, increasing, cooling off now a little bit, but still elevated compared to 18 months ago. High developer premiums, longer grid lead times, etc., and more capital. You've seen Brookfield and Masdar and others come into this space, and that's going to compress that equity yield, and that's why we quite like the debt piece, because no one else is really doing that. And then our long term, as you can see, 11% in our long term on-site area, and that is things like green hydrogen, electrification of transport that I've mentioned already. That's the really interesting piece, and that's why I look forward with confidence for TENT, because we've got the ability to drive higher returns in an environment of increasing base rates, and we're not just committed to a single technology where actually the return has compressed to very little, given its maturity. So that's the outlook for us. Obviously, some really interesting opportunities as we're able to grow. So I guess the final comment then is just, we're really proud of the level of contracted cash flows. We're proud of the results in the year just gone. That forecast earnings we think is, if not the highest, and certainly one of the highest in the investment trust market in our energy space. And what you get by investing across the transition is that really differentiated proposition of a really naturally diverse portfolio of different technologies and different niches. And going forward, our strategy is the same: is to really scan critically the energy transition, not just to go to where the significant sizable opportunities are, but to look for those niches and to find that really interesting risk-adjusted return. And I would say in an environment of higher base rates, that niche strategy that we've been adopting since we IPO'd is more important than ever before. So hopefully that gives you a useful overview of what TENT is about, and obviously delighted to take questions or debate any aspect of the energy transition.
Brilliant, thank you, Jonathan. That's really interesting. There's a few questions up here already. Actually, let's sort of start with the big picture thing. So, one of them. So obviously, you're more or less fully committed now. So, what's the plan for the future? I mean, I know in an ideal world you raise more money and keep going, but if you can't do that, what's the plan?
Yeah, it's a really interesting question. So, I think in the short term, what we're focused on is building out that battery portfolio. We obviously have amortization coming off from some of our loans and ability to reinvest. And our priority in the short term is to really reinvest at attractive levels of return that are, ideally getting towards double digit, because we think those opportunities, as I've mentioned, are there. So that's the sort of short term focus for us. And, I guess longer term, look, that's obviously, as you mentioned, subject to what, the markets allow. It's obviously a difficult time in the markets. We think that we've had our first set of results that really exceeded expectations. It was only our second full year set of results, and we're hopeful that the market now starts to recognize that and starts to reprice. But obviously, like the whole of the rest of the sector, we're subject to the whims of the market on that and what happens there. So difficult to kind of look too further out given the uncertainty in the market, but in the short term, we've got a really attractive pipeline of opportunities which we can still take advantage of, and money to reinvest, as well as building out storage assets, which will drive dividend cover up, significantly north of what we've already shown thus far.
How important is it to have a mix of operational assets with stuff under construction within the portfolio?
I think that's really important. I think you obviously can get higher, the early stage in a project life you go, development, construction, you do start to get those higher returns. And in an environment where investors are rightly looking for higher returns, given that increase in base rates, I think it's important that construction is part of the portfolio. So I think we always want to be taking advantage of the kind of, we've got these allocations we're allowed in terms of, I think it's 5% in development and 25% in construction and development. So I think we'll always look where possible to sort of fully utilize those to drive returns to shareholders. We think that's important. Once an asset's operational and has had a number of years of track record, that's where you start to see the yield compression that makes something less interesting, we think, particularly in the current environment.
So you look to sell that on and reinvest the money?
Yes, that's something. Yeah, so I guess we're constantly looking at sort of recycling in the portfolio at the moment, and that's something that's a very live discussion internally in terms of where are the opportunities.
Good. Okay, thanks. So some individual bits and pieces then. There's the portfolio here. Just for some the viewers here, can you just explain what the upside is from the battery storage investment, and just explain a bit about the technology you're backing and what the attraction is, please?
Yeah, sure. Okay, so number of things to unpick there. So, so the technology is lithium ion as opposed to other sort of storage technologies, and the equipment manufacturer there is Trina, which is an extremely large tier one company that built a very strong presence in solar and is now really growing market share rapidly in battery energy storage. So that's the kind of equipment that we're using, and it's a portfolio of 4 projects. 2 of them are 2 hour, 2 of them are 1 hour, and we've deliberately tried to make sure this portfolio is diverse across the whole of the UK. Wales, Scotland, North and South England, because we think that particularly locational factors are going to drive earnings in battery storage going forwards. In terms of the upside, or I'll give a bit more detail on the structure, and then that will kind of naturally flow into the upside. So we really think that debt is an interesting way to kind of build out battery storage. Why do we think that? If I was to give you some high level data, which I've actually got in front of me, the average revenue in the battery storage fleet in the UK was, I think, north of 143k per megawatt last year. So really interesting returns. Thus far this year, it's below 70. So what you've seen is a real cool off in the returns that battery storage assets are achieving. And we had a sort of slightly contrarian conviction a year or two ago, which was that there's these ancillary revenue streams, one called dynamic containment, which has been particularly driving returns in battery storage. I guess we just felt that that was going to saturate and returns would fall down to more what they were in 2020, 2019. And so I still think they'll be higher than that in the long run. But I think thus far, the operational performance, in battery storage of the fleet in the UK this year kind of bears out our slightly more bearish view. So what we did was effectively lend size to a slightly more conservative revenue expectation. Kind of, we can still get paid our return regardless of needing to achieve those high levels of forecast income and those levels that were seen last year. So that's the way we've approached it. And because there's not many lenders in the battery storage market, it's still a market that banks aren't really comfortable with. There's a sort of real first mover advantage that we're able to take advantage of, and to position ourselves as a key funding partner in this space to quality management teams. So we've structured it as a loan, and we do have a revenue upside, and there are various inflation protection measures in there as well. But yeah, the upside, to your point, is a revenue share that we get, but the primary return is driven through a loan, and the returns are able to get somewhere between 8 and 9, which, when you consider what an equity return on a battery project is, sort of a project IRR basis, maybe close to 9 or 10, we're actually getting a lot of the return for around half the risk. It's about 55% loan to cost. So that's quite granular, but hopefully just gives you a sense that we saw the gap in the market being there, to take a lot less risk, to get similar returns, and to be able to pass on that sort of extra froth in the market, that extra expectation around returns, to someone else.
No, that's good. Thank you. The CHP assets there, are they all greenhouses?
That's right. Yes, they're on site at a tomato grower, providing heat to that tomato grower to ripen the fruit. But actually, the majority of the revenue comes from selling electricity to the grid. So there's 2 primary sources of income. There's also others, such as capacity market contracts and others. So yeah, that's how it works. You're absolutely right, on site with a tomato grower, warming up greenhouses.
And they're gas-fired, small gas-fired plants. Is that true?
That's right. Yes. So 2 of them are Rolls-Royce engines, and one of them is a Yanbacker engine up in Teesside. And yes, they're small gas engines producing electricity, but obviously warming up water as part of that. And then the water is stored and is piped through to warm up the fruit.
So in terms of the kind of counterparty risk, are these riskier than some of the other assets in the portfolio?
It depends. So I guess 2 things to unpick. So obviously we do have, so I would say the majority of income is merchant, right? So selling to the grid, and that's consistent with something like a battery storage asset. So I wouldn't say that's particularly different. Obviously on the hydros, we've got, I guess effectively government counterparties on the other end for subsidy payments. So the kind of minority of income that is related to an on-site counterparty, yeah, you are taking counterparty risk when you do that. Clearly, that's the nature of any kind of on-site any on-site investment. Another example would be our LED lighting, which is, of course, on-site. There's 11,000 light bulbs at a very large logistics business with an investment-grade counterparty. So clearly, when you're on site, you are taking that counterparty risk. We felt comfortable with it in the context of the CHPs. The payment profile has been consistent since we invested. This is a very large and established tomato grower within the UK at a time when there's a real focus on domestic food production. And it's obviously a key part. It's actually an essential cost for them in terms of keeping these glass houses warm. So for all of those reasons, it's delivered so far. It's actually outperformed. These assets have outperformed since we invested, and we think as part of a diversified portfolio with a diverse sources of revenues in those CHP assets that we're comfortable with counterparty risk, and particularly on that and on asset as well as our LEDs, where we also have counterparty risk.
Okay, thank you. Great. Now down here we've got green hydrogen down here in the corner. Is this something that you're actually actively looking at, or do you think it's too early for you yet?
So I think we've seen 4 credible opportunities probably in the last 6 months, and those opportunities have been around funding. Those have been around debt or equity investments to fund an electrolyzer connected to the wind turbine or solar to produce green hydrogen and in some cases the sort of corporate offtake from a large industrial company. So it is early, we're not sort of run over with them in the way we often are with solar opportunities or whatever, but there is a decent pipeline now coming through. The government's just started to move forward on a policy perspective to put in place contractual certainty and incentives. And of course, I probably should have mentioned we're able to fund into Europe as well. 30% of our gross asset value can be allocated to Europe. We haven't done that to date. And green hydrogen in Europe, there's a really strong policy framework sitting behind what the EU wants to do there. So I would say it's not something we've done, but it's certainly something that, again, as ever, subject to capital availability, we could be sat here in 6 to 12 months having done a deal. And I think certainly, so I would say it's probably not too early now. I think it's starting to turn into a steady supply of opportunities. Probably 6 months ago, I would have said to you it's somewhat too early.
Okay, thank you. There's another question about hydrogen, but I think it's actually talking about the hydropower. So I think it's just a spelling mistake. If I'm wrong, then please correct me, whoever asked the question. But here, so on the hydro side of things, is that just sort of a constant generator of power? I mean, where's the angle here, if you like?
Sure. So I'll explain how it works, and then I'll try to come up with the angle as we see it. So there's only about 400 run-of-river hydro sites. This is obviously not pumped hydro, which is obviously a vastly significant and much bigger scale. So these are 9 run-of-river hydro assets in Highlands of Scotland. The way it works is the sort of water goes down through a sort of weir, or travels underground through a penstock as it kind of builds up speed underground in this kind of big pipe called a penstock. Building up speed, it then goes through a generator, which turns and that produces electricity. And these things have typically an asset life of about 50, 60 years. It's considerably longer than things like solar or wind. There's not as lot of moving parts. The water's doing the movement for you, frankly. And you've got the generator, which is the one moving part, but that's very well established technology, clearly. So we like these assets for the long-term duration of them, the lack of moving parts, kind of lower maintenance, and there's only, as I said, 400 of these in the UK. So, they're a bit of a niche, and we're really pleased to have got hold of a portfolio of them. And they've got the edge. What we like about them is 2 things. So I think the main thing is around the subsidy that we've got here. Really attractive levels of subsidy from the government, feed-in tariff, so a price floor, as well as a generation payment. And 3 years ago, we should not forget that there were negative power prices. So there is volatility up and down in this market. And we think a price floor is kind of a really useful thing to have. And then we do tend to get slightly higher returns in hydro than other generation technologies. Clearly the water resources you would expect to be more variable than solar. What we made sure when we bought these assets is we kind of looked at the sort of 7 years of operating history to really understand that risk. And so, we get a slightly higher risk premium when doing hydros, but we also backed it off by using the operational data to get comfortable with that. And so that's, I guess, the angle is the slightly higher returns, as well as the kind of high level of subsidy and the sort of uniqueness and nicheness, if that's a word, of the assets.
Okay,
hope that answers the question.
Yeah. So obviously this fund starts out as triple point energy efficiency. And there's been lots of talk back and forth about what the government's going to do here. And I know you mentioned REMA in passing here, which is the reform of electricity markets arrangements. Is this right? So, but also there's a question here about is the UK going to respond to the Inflation Reduction Act in the US? I mean, how do you see the whole government kind of influence on the sector changing over the coming years?
Yeah, well, I guess very broad one. I guess to kind of try to answer. I guess the first thing I would say is that the government intervention tends to, if you look at this picture here, decrease as you move to the right-hand side of the page. I mean, that's a generalization, but if you think about the electricity generation levy that was levied on renewable power generators the back end of last year, that's clearly an area where there has been government interference. There's been a bit less in battery storage. There are some positive sort of incentives around long duration storage. If I think about what we're doing, say providing LED lights to a logistics warehouse, we're quite well insulated from regulation because it's not something that's is really ever focused on, I guess, in that regard. The government's behind the meter. So I guess we think one of the benefits of diversification is you're not focused on any single one government policy, some of which can be helpful and some of which can be less helpful, as we've seen over time in the energy transition sector. I think, no, I don't think, much as it might be great if the government did respond to the Inflation Reduction Act, I don't think it's credible. I don't think it's realistic. What I think the government can do at very low cost is speed up times to get grid connections, to get more assets built. I think the government could provide more certainty around things like hydrogen CFDs. It can provide just more clarity on that sort of thing. Planning is still something that slows down the build out of not just renewable assets, but property, real assets, and more broadly holds back a significant number of parts of the economy. So again, those are things for pretty low cost the government can do. So I think it's about trying to, if we can't compete with the sort of financial heft of the US, it's about being nimble. It's about a kind of really good regulatory environment to build stuff. And to be fair, we've seen that with battery storage. The UK and Ofgem in particular is regarded as a sort of global leader in some of those ancillary revenue streams that we spoke about, dynamic containment and capacity markets. So we can and have been a pioneer in so much of this stuff. The UK is one of the pioneers in the net zero transition in Europe, with one of the first to have binding legal targets towards it. So I think it's just quality. Good regulation actually is probably a pretty reasonable substitute for the sort of wall of money. Clearly, it'd be great to have both. I think as investors, the best thing you should do is to be diverse and not reliant on any one area in case it gets taxed, like electricity generation levy, or in case, to your point, REMA changes things, brings in geographic pricing, and suddenly all the wind fleet in Scotland is getting a lower price because there's lower demand up there. That would I think be something I would be mindful of investing in this space.
Yeah, although I think that could be quite exciting because there'd be a reason then to locate the industry where the power is.
Yeah, absolutely. I think it could be, we talk about leveling up, you could absolutely, to the extent it's reasonable, you could absolutely move industry there. Clearly, very heavy centres of industry, such as, I don't know, Port Talbot or Steelworks in Sheffield are kind of stuck where they are. But absolutely, I think that could be catalytic as part of a broader industrial strategy. I think it would need that joined up thinking. But what it will mean in terms of people investing into this space, thinking a bit more narrowly, is there'll be significant winners and losers. People who are on the wrong side of demand, with assets that are fixed in the ground, they're stuck there and there's lower demand, which means lower prices. You could see a repricing of certain assets in that sector. So that'd just be something that I would point out for people to consider. But you're right, there's upsides as well.
Yeah, good. Okay, thank you. Now there's sort of some big picture things here which I've been saving to the end. So, firstly, you've been talking here about the returns available on things like solar and wind and the bog standard stuff. Do you see those yields widening from here? Is that the logical? I mean, because that's kind of what discounts are implying, that those returns are too low.
Yeah, I think you've seen. I think my personal view, is that it's a really tricky time to price assets in our space. You hear anecdotally of someone, doing a deal at some really kind of quite strange pricing. I think there's a lot less deals getting done, and so when we talk about market comparables or pricing comparables, it's quite hard, I think, to kind of have a real sense of where the market is in the way that we would have been able to do a year ago. So that's, I guess, my disclaimer at the start. We are starting to see, yes, I think discount rates for solar and listed funds have ticked towards 7%. Our pipeline numbers here include debt and equity, to be clear. But I do think that, I guess the broader point I'm trying to make is that there are some parts of energy transition where returns have compressed so much because they're so mature that it's going to be difficult, I would worry, to attract lots and lots of capital into them, given the compression in returns. That isn't the case across all of the transition, but in those more mature areas, it is. So, yeah, I mean, I think there is a case that says, well, if you've got a base rate at around 5%, generation assets need to be yielding a decent chunk north of that, as they were a year or two ago, to attract capital into it. And I would query whether it's certainly in the short term going to get to that level. So I guess much of the question is, yeah, I mean, I think yields are moving up gradually on discount rates. Are they getting people interested and getting excited? Well, the share prices of most of the sector indicate no, let's be honest. So for me, it's about trying to work out, well, where are the interesting areas of returns that are still interesting to investors in this higher rates world, and that's why we're pleased to be diversified and able to attract those opportunities, particularly in the on-site space, and to a slightly lesser extent storage. I don't know if that answers your question, but I think that's kind of what we're seeing on the pricing of assets.
And then sort of linked to that, is there any way that you can envisage where the industry can actually tackle the discounts to NAVs and actually return to raising more money?
Yeah, great question. I mean, I think a lot of certain trusts in the market, and I mentioned we spoke about this earlier, are looking at their portfolio, are saying, well, if we can sort of prove the NAV by selling some of our assets, does that get people interested? I, again, personal view, don't know if that fully works, in the sense that I think part of the reason is, there's a debate around are share prices where they are because people don't believe the NAVs? I don't know. Or is it more that simply compared to and I know this isn't a perfect proxy, a investment grade bond or other asset classes, is it actually that quite simply, the risk adjusted return for that asset class isn't interesting? It's not that we don't believe it, it's just that it's, we're allocating elsewhere. So I would say, in terms of how the sector gets back to trading at a premium, it's about being able to show that there are areas for growth that kind of can drive returns higher than that sort of counterfactual, the kind of alternative use of money. We think there are very interesting niches in the market, but I think for those that are sort of anchored in a kind of more mature part of the market where returns are lower, my personal view would be, it's tricky to see that in the short run without, I guess, to kind of try and end on a more positive note, a material decrease in base rates, which could take, a while. Yeah.
I think you're right. I think obviously maybe a while for interest rates to come down, but I suppose it will help if they stop going up.
That would be really helpful, yes. Really cool. Helpful.
Good. We've covered a lot of ground there. Thank you, Jonathan. And I think we're sort of out of time. But no, I think that's really interesting. And good luck with everything. And we will talk to you again in a year or so, if that's all right.
That sounds great. Thank you very much for having me on. I really appreciate it.
Thank you. So we'll be back next week talking to Gervais Williams. So when we got in touch with Premier Mike and said, can we talk to Gervais, please? And I think they thought we were going to talk about diverse income or one of the other ones. But actually, I'm quite interested to hear what he's got to say about micro caps, because I suspect he's going to be quite bullish. And they've been some of the worst performing bits of the market so far. And I think he might be thinking that now is a good buying opportunity. So it's going to be an interesting story anyway when that happens. So have a great weekend, and we will see you next Friday. Thank you very much.